Good afternoon, everyone, and I hope you are all well, and thank you for joining us for this South West and Bristol Regional Economic Briefing by our Head of Research, Dr. Walter Boettcher. For those of you who I've not met before, I'm Richard Coombs, Director in the National Capital Markets team in Bristol, and for my sins, I've been asked to host this event. This being a web-based presentation means that we can't see you or hear you, but there will be an opportunity for questions and answers at the end of the webinar, and you're welcome to send in messages with questions via the Q&A button at the bottom of your screen. In addition, we'll be taking some polls during the course of the presentation for you to respond to. We expect to wrap the whole thing up within about an hour. It's now more than 3 months since the organisers of MIPIM has announced that because of concerns about coronavirus, the event was being postponed from March until June. And well, here we are, 2nd of June, and it's been cancelled, as you know. Colliers Chief Economist, Dr. Walter Boettcher, was to have launched a research paper on the UK regions and cross-border commercial property investment at MIPIM. Instead, he's updated it to take into account the impact of COVID-19 and is publicly presenting it for the first time today. Walter has over 25 years of experience of the UK and European property market, and he was one of the first to call it right on the 2015 general election results, which saw a Conservative majority, and also on the 2016 US presidential election when Donald Trump beat Hillary Clinton. Walter has long been a keen proponent of UK regional development and infrastructure investment. As you might expect, his views on regional investment and the effects of COVID are well worth hearing. I'll now hand you over to Walter so he can tell you for himself.
Yeah, thanks a lot, Richard. This is very strange. I mean, Bristol's like, for me, it's like coming home. Every year in April, we usually do this round robin of companies, and we do these really short, concise presentations and elicit feedback and everything. And so to be speaking to a Bristol crowd without actually being able to see anybody, this is a bit strange. Okay, well, look, let me jump in. He's quite right. It was about the MIPIM message, and the paper was going to be called, or is called, Regional Revolution 3, the rise of cross-border investment. And it's all really about the rise in regional market liquidity, but I'll come back to that. Now, looking at the cover design on this, I still don't know what this means. I see a yellow thing in the back, which looks a bit like a sun. Maybe that's Asian investment, I don't know. And then I see something that looks a bit like a wave, but it's a bit checkered. I'd like to think that's the wall of capital that's headed west to assist us in all the regional development plans that we have, and generally sort of the wave of investment. But quite honestly, I'm not quite sure what it means. If anybody has any good ideas, just drop me an email. We can go through that. So look, what I want to do is I want to talk to you about sort of why I got interested in the regions originally, regional development, and particularly about devolution. And then I want to talk about some numbers, and there's quite a few charts in this at some point. Hopefully they're interesting. And then I want to look at where the regions were before the great financial crisis and after the great financial years, let's say. And then what comes after what the effects of COVID have been. Well, let's start back and take it sort of at a leisurely pace here. And the only reason I'm showing you this slide says Manchester more German than British is because this is sort of where my my work on the regions began. We were coming out of the global financial crisis, and I was getting very frustrated because so was Richard, no doubt, because there were very few investment transactions in the UK. And certainly not that many cross-border investments. But yet, when I looked at the equivalent big six cities in Germany compared to our big six, they were getting far more investment. Listen, it made me cross. So I started looking at it in great detail and realized, first of all, that all the German regions were far more decentralized than the UK, and that all the regional economies, too, were far more specialized. I since found out that was an understandable thing because in the UK, of course, it's always been more of a centralized system, and regional economic planning was often done from the center rather than from the regions. I think that's changing, but when I looked at the numbers, it suggested that maybe Germany had some sort of advantage as far as investment went because they were able to set up their own, determine their own good comparative advantages and choose the industries they wanted to work on, right? And then central government came in, of course, to assist with transport infrastructure and assist in agglomerating these economies. And the UK is going through the same thing, but Germany's been that way for years and years and years. I'm not suggesting it's necessarily the best model, but maybe that explains why they were getting more investment. So then, this is called Regional Revolution 3, and I produced, this is the third of 3 papers that I did. The first one was called Regional Revolution, Building the UK Powerhouses. I did that in 2014. And that one came directly in response to the if, and, or but, or the whether Crossrail of the North or HS2. And I looked at it, and if I decided that if I had to have one or the other, probably the Crossrail of the North added up for me, because I saw the biggest possible economic gain and increases in productivity coming from investing in agglomerating the economies in the North and putting in the infrastructure to allow that to happen. What that means is that if you agglomerate a city, you can basically turn, say, Manchester and Leeds into one city region rather than into multiple separate cities. If you make the access so good, then the employers in both places have access to a much greater work base where they're likely to find the people they really need. And likewise, the people that live there have a much wider access to companies that might have things or might have offers that are more in line with their own expertise. Hence, there's a productivity boost just by linking things together. So I started looking at all this, and I suddenly realized that if you, agglomerated these economies, and I think I picked Liverpool, Manchester, Leeds, Sheffield, and Hull, and I created one entity out of it. And I started adding up the numbers, and I suddenly realized that this new entity was definitely bigger than the Ruhr Valley in Germany, no question about that, as well as a lot of other agglomerations around the world. So I'm thinking about this, and I'm thinking about publishing my paper, and I thought I should give a name to this agglomerated system of economies that I had. And when I looked at the map, it was crescent shaped, so I thought to call it the Northern Crescent. Well, of course, that had certain connotations, and we thought, well, maybe we would go that direction, But while we were hemming and hawing over this, that very month, literally, a week before I was going to release the paper, George Osborne stepped up to the plate and had his Northern Powerhouse talk, which pretty much completely scuppered the presentation that I put together, because it looks like I just pinched all his ideas and published them under my own name. A lot of the thinking that I had was very similar to the sort of things that Heseltine had begun with years and years and years ago, and which Osborne had started to implement really quite effectively. Not too many people knew this story. Philip Hammond, the chancellor, got it and understood it and didn't get in the way of it. Theresa May, of course, famously turned her back on the Northern Powerhouse and walked away saying, no, we need a proper industrial strategy, which harkened back to the days of centralization, which was the very thing that I was moving against. Boris, I think, I don't know if he gets it or not, but he's definitely moving in the right direction. I think in fairness to Boris, I think he does understand it, and he understands some of the theory behind it. And so I think that in that respect, that agenda will go forward. So that led to a second paper, Regional Revolution 2, you could call it, which looked at devolution, and particularly the role of the new local combined authorities and the new mayors. And of course, I'm a commercial property guy, so it was in connection with commercial property. But I asked the more fundamental question of how are the local combined authorities intended to work? Now, look, I could give you an hour on that, but I'm going to give you just a couple of highlights. I think that the main point of this is that if you combine authorities and you stick in one person of responsibility, i.e. the metro mayor, his main task, the way I see it, is to assemble all the local stakeholders, whether it's the businesses, the unis, the local councils, the population for that matter, into a cohesive whole to try to work out what sort of projects should be undertaken, what sort of economy should be pursued, i.e. focus on what is our local comparative advantage, what is it that we can do better than everybody else, and in that way, you develop higher value add functions in your region so that productivity goes up and everybody wins. But I think another very important point too is that if you get all these people together, the international marketing becomes far more powerful, particularly to the perceptions of cross-border investors who like to see that some region they're investing in is linked up and understands what everybody is doing. And I think probably Manchester was definitely in the forefront of this and had been doing it for years and years, informally, if not eventually formally. And if you've been to MIPIM and see the show that they put on, it's definitely really quite impressive. So that brings us to Regional Revolution 3. Well, what's this all about, right? Well, it was about the BIP message at the end. And I think the main thing I wanted to look at was ask the question, have the regions become more investable since before the great financial crisis? In, say, in the last, well, I picked two time periods, 2002 to 2006. That was a cycle before the big crash. And then 2014 to 2018, which seemed to be, to me, a similar period, cyclically speaking, although it's a bit complicated. So then you immediately raise the question, well, if devolution is supposed to have all these impacts, is it too soon to say whether devolution is having an impact on regional investment volumes? Well, I thought, well, let's not answer the question right away. Let's go and have a look and see what the data shows us and see if there have actually been improvements between those two periods in the regions. Okay, so why is market liquidity important? Well, it's linked to the ease of doing business. You know, if you're an investor and you want to put money into Liverpool, Sheffield, wherever it's going to be, one of the things that you want to know is that you've got an exit. And one of the ways that you can be assured of having an exit is if you have a market that's large enough and liquid enough, i.e. enough transactions going on all the time, that you can move in and out as you want. And so that at the most basic level is what liquidity is. One metric is just simply how big is the market, you know, how many transactions are there and how big are the transactions, you know, the scale of the transactions. But then another measure of liquidity would be what I would call market depth. So how many different types of investors do you have investing in a market? You know, what is the diversity? And I've got a list on here: institutional, private equity, sovereign wealth funds, and on and on. A third measure of liquidity could be considered market leverage. Now, you know, ease of funding, easily put, the availability of cost of funding, and especially refinancing is very important. You buy an asset with equity, you want to refinance at some point after you've done the deal. Is the money there and available? The answer is generally yes, but I can tell you that regionally, not all banks are that exposed to the regions. There are some banks that specialize in it, there's others that do not, as it were. That's another measure. And then I would argue too, on the back of all the devolution chat that I gave you, that there could be something called political liquidity. You know, which markets are best organized in terms of attracting capital and building confidence. I thought about trying to produce a list and quantifying that, but I figured a couple of things that happen. I'd probably make a lot of friends, but I'd also probably make a lot of enemies too. So we'll leave that one alone. But I do think that it does emphasize the point that local political leadership is really crucial to these markets. So without hesitation, let's jump to a preliminary finding, and that is that UK total commercial real estate investment increased in between the two periods, that is the 2002 to 2006 period and 2014 to 2018 period. You can see the chart on the top right there, and the regions are in orange, so it goes up to pretty much the same level. Excuse me. Not definitively, but it's up. And then if you look at London, that was up until Brexit sort of knocked it on its tail a bit. But this is where we get suddenly the surprise preliminary finding, because whereas the nominal value of transactions before inflation, excuse me, went up from 221 billion to 317 billion across the UK as a whole, in real terms, it actually fell from 221 billion to 217 billion. Not only that, but the scale of the transactions actually went down from 18.7 million to 14.3 million. So I can tell you at this point, the BIP message was in trouble. You know, I don't necessarily try to be a harbinger of happiness, but I do tend to be optimistic, and I do look for the positive messages in all the data that I deal with. And I was struggling at this point and a bit worried. This was January. I didn't have too much further time to work. So let's look into the numbers a little bit more. Maybe we can see where this all leads. So it fell in real terms overall, but if you break it down regionally, so on the top right, you can see London in gray and the regions in orange. In terms of deal numbers, the number of deals in the regions went up considerably, and in London they also went up. But in terms of value or volume, we call it investment volumes, whereas London went up about 23%, the regions actually fell by 7%, you know. And if you looked at the scale of individual transactions, the average transaction size, that actually fell by 31%. in the regions. So look, this as I dug into this, it got worse and worse and worse. Definitely problematic for MIPIM. So I thought, well, let's look and see why this could be the case first off before we dig a bit deeper and try to figure out exactly what's happened. And I remind you of a lot of things that we already know. One is that our operating environment since the global financial crisis is very different. One of the key impacts has been a limitation of leverage and much greater bank regulatory oversight, especially what they call slotting, or the risk weighting of capital buffers that banks are required to have. It used to be that banks would look at all and sundry with various risk profiles, but given the new regime, all they wanted was big ticket items with low risk, which sort of had a bias toward London. So that would be one sort of indicator. The chart on the right, by the way, in the blue, I think is the most interesting one. The average maximum loan to value of all transactions back in around 2006 was around 78, 79%. And now if you could squeak out anything above 60%, you're doing pretty well. The other bit too is that the bank, like I say, the slotting affected the appetite for less secure deals. So consequently, lending to construction and development it's been negative ever since about 2008. Oh, there's a little brief period there in 2016, I suppose. But this is consistent with the message that banks only wanted large and secure deals. There was virtually no pure speculative development. Certainly not around the regions, which is where you'd expect to find it, which meant that this resulted in a lack of investable standing stock. And I'm sure Richard Coombs will tell you about this. He's always looking for things to sell. It got a bit dry there for a while. Things have eased up in the last couple of years, and I think a little back. Sometimes the punchline to the whole story, as it were, is why it went down. This has everything to do with shopping centers. Okay, so shopping center transactions fell by nearly half between the pre and post global financial periods. The regions, furthermore, accounted for 73% of the global financial, pre-global financial shopping center transactions by value. That's pretty much most of the shopping centers in the country. And afterwards, they also accounted for a similar percentage of transactions, except that the values had fallen too. So consequently, when a couple of things happened, over on the right, you can see the numbers. The number of transactions fell by almost half. Well, it did fall by half. The nominal value fell by half. And the real value fell by about 20 billion. And that's enough to actually explain the liquidity problem. But I thought to myself, this is a bit of a contrived message to take to MIPIM. I guess better to save it till the summertime and to give it to you guys, as it were. But I do think that it really illustrates just how big those assets were. If in fact you stripped shopping centers completely out of the equation, you would find that regional liquidity across all the other asset classes would have gone up by 21%, pretty much in line with London. And I took that as a positive takeaway from this initial bit of work. There's other things I think that mitigated against regional performance, not just regional, but UK performance generally. We've been through a lot since the global financial crisis, ignoring the Eurozone stresses of 2011, 2012. We had the oil price crash in 2014, which falls into our little 14 to 18 interval that we use for doing all these numbers. We had the Scottish referendum in 2014, which provided a bit of distraction for investors. We had the Brexit vote in 2016, which brought the markets to its knees for a better part of a month or so. We also have, what I would argue, I think that UK electoral uncertainty was actually really quite critical from 2016 onwards. Excuse me. Cross-border investors also, I think, though were encouraged by the sterling devaluation, that was about the only good thing to come out of it. I'm getting a message here that sometimes my connection isn't so good here. So let me sort of deal with that while I'm dealing with the presentation. Bear with me just a second. Okay, we'll leave that sit for the moment. Okay, so the other thing to say though is that all of these different events hit the regions in different ways. So if you look at the chart on the upper right, you can see Aberdeen was roaring on the back of the high oil prices that were, came before, 2012, 2013, and early 14. And then when it collapsed, it suddenly brought that to an end. But nevertheless, in our transactional period, it showed it did spawn a lot of development. Equally, the likes of Liverpool and Manchester saw huge influxes of Chinese capital. Birmingham and Sheffield did all well on the back of their manufacturing story. Bristol is sort of in line with the average. I think some of this is impacted, of course, by the shopping center transactions. And then Glasgow and Edinburgh, I think, showing the results of primarily the oil price crash in the Scottish referendum. So there's a lot of reasons. But the good news out of all this, or not the good news, but the informative news, on the bottom right, you can see the chart, the working age population outside of for the G7 in China, shows that the working age population was actually peaking around 2015, right? That means all these people are paying money into pensions globally, and also the world is aging also. So consequently, this has resulted in a huge savings glut and a huge accumulation of capital globally that's looking for returns. Listen, if you can get, 4% on property and you can get 1% on bonds, you're going to go for well, at least I'm going to go for the property. There's a lot of other criteria that go into it, but I think that explains the weight of capital. It also explains, I think, why things have been as robust as they have, despite all of these episodes that we've had. So, like I say, sterling was devalued and cross-border investors were really encouraged. But I think there's something else here too, which, and I don't mean this just strictly humorously. Performance of some of the regions, I think, were driven by cultural influences. Man United explains an awful lot of interest in the Northwest. I'm serious. You talk to anybody up there, they'll tell you that. And there's, the entire world is football mad, and Man United was enough to draw people in. So then I got to thinking about Sheffield, of course, and there was a £1 billion commitment from the Chinese a couple of years ago to run over several years in development of Sheffield Center. And I did some looking into it. And did you know that there's 50 million Chinese snooker players? They're absolutely snooker mad. And I saw the crucible there and I go, oh, come on, this has to be. And there's other people that have actually suggested that to me also. So then I thought I had to do a trip to Japan some time ago. And I decided to work out with the Japanese fanatics about curling. There you go. Perth is a center, and so is Tudbridge. So there's your hot tips for future development sites. I'm not sure if Perth or Tudbridge are really ready for it, to be honest with you. But needless to say, I think the point I wanted to make is that a lot of cross-border investors are very interested in a sense of cultural attachment to place, whether that comes from the universities that they sent their children to, or whether it comes to sporting events. I think that is an important feature of the story. Certainly, if you look on the right here, on the top we have that same chart about investment into the regions generally. At the bottom is the investment of cross-border. So you can see pretty much across every single city here that I've listed, the cross-border element has increased between the two time periods, despite the general level of transactions having declined in the regions. And I think that's really the big story of today, and certainly that was the saving message for MIPIM, that it was all about cross-border. And if we look at it a little bit more depth, you can see that the overseas share between the two periods, 2002 to 2006 and 2014 to 2018, increased from 24% from 18%. Now 6%, it doesn't sound like that much, except it belies the scale of the change for a couple of reasons. One is that the Irish were a big part of investment prior to the global financial crisis. And you can see that in the second period, in the 2014 to 18 period, they have dropped completely out of the equation. And in some ways, you probably could consider the Irish as domestic investors, quite frankly. And if you did it that way, then suddenly the overseas shares, i.e. outside the British Isles, increased, doubled from about 12% to 23%. But I think all of this chart illustrates a bunch of other interesting stories too. But first of all, whereas the Irish fell really precipitously, they tend to be short-term investors that were looking for high returns and high leverage, which of course they had. It was one of the reasons we had the financial crisis But on the far right-hand side, you can see the Asians, which increased their exposure enormously. Now, they're not short-term investors, and they're not looking for highly leveraged returns. They're looking for a modest return over a long period of time. Very fundamental difference in what they're looking for. And I think it's qualitatively different. The U.S. Looks like it was up a bit, Germany down a bit, Europe's up a bit, Middle East was up a bit. I think Middle East was interested because suddenly there was a crackdown on a lot of the families there that had a lot of money, and I think the government was trying to fill the tax pots, and so they decided they'd start looking to put their money elsewhere. That may explain the Middle East lift into the regions. But certainly the Asians are out there looking for big ticket items, and I think they're probably going to continue to do that also. Deal sizes, I think, also are really quite important because I can remember way back when I was talking to one of our investment agents from Birmingham market, and I think there was a building under offer that a lot of it was leased to Deutsche Bank, I think it was, and it was on the market for about 100 million, 110 million. And this is maybe 2011, 2012. And I said to the investment agent, why is there no interest in this? And he goes, well, for the regions, it's a pretty big asset, Walter. And I thought, what are you talking about? It says Deutsche Bank is Deutsche Bank, for goodness sakes. It doesn't matter whether they're in London or but who's the alternative to Deutsche Bank? Well, I think too that what's happened over the years is there's been a huge diversification of the tenant base in regional cities. Certainly Bristol, I've seen it with all the professional services they have there. It sort of ticks that back. And I think that gradually cross-border investors in particular, as they invested in London, form partnerships and then would go a little bit further afield to find a little bit more yield, and they do a tentative deal and it worked out, it was fine. So they did a slightly bigger deal. And so just through familiarity, I think the scale of transactions has grown, and that's what comes through the data here. If you look at I get confused by these. Let's see, UK institutions have actually gone down in terms of the scale of their transfers, their purchases in the regions. Also in London, whereas cross-border have gone up. And if you go down to the bottom right, Asians have gone up really quite significantly, as have the EU, whereas the US, the Middle East, and the privates have all fallen, which I take to mean in some measure that Asian and EU investors appear to be squeezing out domestic institutions in terms of taking larger assets in the UK region. It's really quite extraordinary when you think about Brexit and all the rest of it. So look, there's some key messages that come out of this. I've got a few more to say about the economy here, but from this initial piece of work, I think probably the availability of cross-border capital for regional development, for me, it was a big takeaway. And also this too, that UK investment as a whole is not a zero-sum game. It's not like the government has, 500 billion to divvy up, and whatever goes to London is not going to go to the regions and vice versa. There's enough global capital to float all the boats in London and elsewhere. Let's see. I would say about London, though, that it does retain its predominance as a gateway city. So investment in London may, at some measure, investment, not government investment, but cross-border investment or just general investment, because in many places, London is still considered to be the Microsoft solution. Now, what that means is if you're an IT manager and you buy anything other than Microsoft to do the job and it doesn't work out, then you probably lose your job. But if you buy Microsoft and it fails, well, then you did the best possible, as it were. But I think those perceptions are changing too. And I'd argue too, to go back to the devolution agenda and the local combined authorities and the marketing of the regions, I think that's one of the key missions for the new local combined authorities and the cities when they go to MIPIM to help change those perceptions and to show what is actually available across the UK. But look, there's always some flies in the ointment to all this excitement. Look, I tell you what, I think we got a poll. Leah, can we do that first poll? Just want to get an indicator of sentiment about economic recovery. Yeah, so if you can see that, just click on this one. How confident are you that the Southwest will fully recover from the pandemic and its economic impact? Fully confident, somewhat confident, not confident at all. So I'll give you about another 10, 15 seconds to click the box, and then I think we probably see a result. Yes? Somewhat confident, fully confident. Okay, there's that. I'm part of the 31%, I have to say. Not confident at all. Well, I got some work here to do to convince you it's going to be okay. Here we go. All right, so COVID virus. Yeah, look, so it's been a hit. There's no question about that. We're in the process of being hit. It's not over yet. And from what I can see so far, it has basically accentuated most of the trends that we were already seeing. I show you the forecasted path of GDP recovery. This is for the UK as a whole. If I broke it down individually by region, it would look almost identical to this. There's all sorts of reasons for that. But first of all, in orange is the quarter-on-quarter path. And that just shows that by Q3 that we're back into solid growth, and and that we're growing at a fairly healthy rate. It doesn't necessarily mean that we've recovered all the lost ground, though. And it starts to taper off and revert to norm after a while. But the blue one, I think, is really quite interesting. That shows the percentage of GDP that we were at the end of Q4 19. So that falls, and it takes a good year and a half to recovery. That would be the sort of figure or the level of GDP that would be consistent with certain levels of tax revenues and all the rest of it. So I would suggest that even though the quarter-on-quarter figures are going to improve probably reasonably rapidly, I'm not so convinced they're going to go all in Q3 20. It might be Q4 20 before we see the real boost. But I think this longer-term projection is really where we're at. And of course, we have all sorts of opportunities to get in more trouble. In between that, we've got the EU and UK negotiations going on as we speak, and Brexit. I'm happy to answer some questions about that too. And then there's the US election, and I just don't even ask me about that one. But within this context, you got to ask if there's an upside for the UK regions. Oh, look, I did sync the chart in after all. Remember I said to you that the V-shaped recovery looked pretty much the same for all the cities and regions. So there you have it on the top right there. It's all because of the way they go about forecasting. Some have done a little bit better than others. The way the recovery is going to work is this. The main hit to the economy has been through consumer spending. You know, it's especially discretionary spending. That will be the first thing, the first stage of the recovery. That was also the first stage of the immediate impact. The secondary recovery, and we don't know just how well that's going to run yet, will be more impacted by regional specific exposures. So we know that the aerospace industry is being hit, but it's not like they've shuttered the shop immediately like they've done with a hotel or retail. It takes a while to wind things down. In the meantime, maybe the economy starts to shift up again. You know, tourism is another one too. It's definitely turned off immediately, but it comes back a little bit faster. So when you look at the regions, I think there's like a two-stage recovery. There's the consumer spending-led part of the recovery, and then there's the general manufacturing and industrial production part of the recovery too, and that's going to happen at different speeds. If you look at the bottom right over on the right-hand side, I looked at what the total amount of GDP growth is being projected between 2019 or between the end of 2004, and they show the UK growing at about 12%. So what is that, about 2% a year, which isn't a bad rate, generally speaking. And then I ranked everything according to where the recovery would be stronger. And it's stronger. Okay, like London is up by about 1.5% of that, so it'll expand by about 13.5%. Manchester about 13, Edinburgh by about 12.8, 12.5 for Bristol. But it's all within about a 1% margin. So I wouldn't say that any of these figures would suggest there's any sort of super overperformance of any one region or super underperformance of any other region. It's just a relative thing. And I think what it means is that this recovery that we're going to go through will be UK-wide generally. There's no reason why it should be overly sector specific unless some disaster happens, you know, in aerospace, you know, with the airlines. That's a whole other story there. But the other part of the equation, and don't underestimate this, is going to be the impacts that come from government investment. Now we know as part of their manifesto, they pledged to rebalance the UK economy. Of course, we've been hearing that for many years, but I think actually they're in a position to do it now, and I think Boris is really quite committed to it. But I have to, warn you ahead of time. But I'll talk a little bit more about it here in a minute. That there's only so much government money, and they can say that they're going to put 500 billion into regional development over the course of the next 5 years. But quite frankly, we need a few trillion to really do all the sort of development, regeneration, and all the rest of it that could be done within that time frame. And going further ahead, a generational thing, we're talking about even vaster sums of money than that. And this is where I think the cross-border appetite for regional investment fits into this equation. It's meant to supercharge government investment. Government investment can well, I'll give you a good example. Birmingham, they had a Paradise project in the middle of town, which is fundamentally transforming the center of Birmingham. And that all began with a £50 million grant to the local enterprise partnership, of which Andy Street, I think, was chairman at the time, back around, when was it, 2012, 13, 14, I forget. Anyway, so he did the preliminary planning, he did the preliminary site preparation, and then had a chat with Hermes, which said, oh yeah, we're happy to kick in a few $100 million. Suddenly, as that got rolling along, Canadian Pension Board investors came in and threw in another couple $100 million, and then Hermes put in another tranche. And listen, offshot 50 million, I think it would be about 70 million seed funding is what I would call it, resulted in a project that was worth 1.2 billion. That's the kind of stuff that I think gets me sort of excited, and I think that's really the transformation that needs to happen right across the UK in order to do all the regional development that needs doing. So what do we have? Okay, well, we've got Rishi Sunak, who's promised, I got the figure wrong, it was 600 billion over the next 5 years. Okay, so this is a lot of money. Let's not, I didn't want to belittle the amount that's being committed. And this is dedicated for improvements to roads, to rail, importantly, digital infrastructure. And a lot of that will be allocated locally, particularly to the combined authorities, which is one of the reasons that they were set up. So there's a lot of money that's going to go into the system, which is, from a real estate perspective, is super supportive of real estate. Public net investment, according to some accounts, is the highest since 1955 in real terms, right? Now, unfortunately, like a lot of these things, we're a bit stalled at the moment. The detailed capital allocations will only come probably with the autumn spending review now. And one of the reasons for that is because it's dependent on the formation of the National Infrastructure Strategy, which I know that Rishi Sunak was trying to release at the same time of the budget in March, but unfortunately was delayed because of the Heathrow ruling. That was that the planning consents that were issued for the third runway were incompatible with the UK commitments to the Paris Agreement, the climate agreements and all. And so now the National Infrastructure Strategy is being reviewed to make sure that it complies with all of the international agreements that we've made. In the meantime, there's a lot of other things going on from finance. There's calls for the domestic replacement for the European Investment Bank to focus on UK infrastructure finance and especially private investment. So there's a lot of people that are thinking about the things that I'm thinking about, probably with a higher level of sophistication and expertise than I can bring you. Nevertheless, I think it's definitely the right way forward. Private money is going to have to play a role in this one way or the other, whether it's through domestic institutions such as pension funds and the likes, or whether it's cross-border investors and sovereign wealth funds. Well, listen, I thought I had one more slide, but that's okay. I just want to talk you through some stuff about Bristol. Now, I said to you at the beginning, the way that the role of local combined authorities is to work together with local stakeholders to bring together plans of sufficient scale and investability so that we can track in capital so that this whole regional rebalancing and development agenda can progress, and so that you can augment government spending with the private type investment. And I think what's happened with COVID, which is a bit of a surprise, it's given it a little bit of a boost in an unexpected way. So I could give you other examples, but if we pick on Bristol, excuse me, The West of England Combined Authority, run by Mayor Bowles, has formed something called the West of England Economic Recovery Board. Now, what is this? This is a body that consists of the mayor's office, the head of the local enterprise partnership, Steve West runs that. Businesses are in there, all the sectors are represented, universities are in there, councils. Listen, these are the stakeholders I was talking about. And they have one basic remit, and that is to plan for the recovery and to carefully manage the unlocking of what's going on, right? But as some of the commentary that I've seen in the press says, they're not looking just for recovery, but for the building blocks for pure advancement. And they also made the comment they wanted to speak with one voice to central government, which is another reason why the combined authority was set up, to do exactly that, so that they get their fair share of the infrastructural investment, So I think in terms of, of kickstarting this whole process of local dialogue to achieve the sorts of things that the local combined authorities were set up to achieve, I think this COVID response has actually given it a decisive impulse forward. And I'm really looking forward to see how that's going to play out. Well, look, I will stop there. There's plenty of time for question and answers, but I also wanted to give Richard Coombs a chance to say something about the Bristol Arena, because we were chatting the other day and we realized that in many ways, because of the infrastructural planning that's going into and the history that's gone into it, and also the foreign interests that are involved with it, it seemed to be an example of something I was talking about. So Richard, do you want to say a couple of words?
Well, just a quick one, really. I mean, I was chatting to Walter about the history of the arena, anecdotally about something else on another call the other day. Just mentioning that in terms of private and public partnership, the island site where the arena was to go, and it's no longer going, is now a major redevelopment funded by Legal and General, where Bristol City Council are putting the land in. L&G are going to build on 5 acres, around about 560 new homes, a conference centre and a large hotel. So that's a good example of a joint venture between public and private sector. It segues into where we're going with this arena, which is up at the Brabazon Hangar at Filton, which is being developed out by the Malaysians, YTL, with their money, but infrastructure going in from South Gloss and Bristol City Council in terms of the rail and road infrastructure around it. So there is activity on those lines going on in our patch too. Walter, do you want to just go back to these polls? There's, I think, a couple more questions that we haven't covered yet.
Yeah, sure. Let's do, Leah, could you give us either one of the questions, maybe the devolution one. Oh, there we go. Given the pandemic's negative impact on the UK economy, do you think that the government will keep its manifesto commitment to invest in the UK regions? There you go. Gets right to the point. We've got some other questions coming in too, by the way, Richard. Yeah, okay, all right. Okay, let's do the other one while we're at it, Leah. So 68% think they're committed, 38% no. Do you think that devolution and the new local combined authorities will make a difference in attracting more investment? There's a good question. Oh, very good, very good. Yeah, I think you're absolutely right too. And I'd say too that the only reason I got to know Mayor Bowles is because I go out to MIPIM every year, and he's set up a presence there, and I went and sought him out along with the other regional mayors. They're all out there, Andy Street from Birmingham, and excuse me, and the others in the north too. And it's a great networking event. I'd say one thing though, I've gone to a lot of the Inward Invest functions out at MIPIM, and I started to do these little polls whenever I start to do a bit of speaking about the region. And, one of the polls was, first of all, is how many bankers do we have in the room? And there might be one, but there's not usually very many, And then I ask how many investment funds are in the room. There might be one, there might be two, if we're lucky, right? How many developers? Probably about 8 or 10. How many sort of local government people? About 8 or 10. All in all, of the crowd of maybe about anywhere from 30 to 50 people, you probably only got about maybe 5, maybe 10% at most of people that are involved in finance and direct investment. That has to change. I think that a lot more could be done to try to bring them on joint events. Now, I do recognize that there's a lot of networking that goes on in the background, and I do know that there's a lot that go on in the stands. But I do think that the opportunity to showcase really needs to be in front of international investors in particular. And primarily when I go out to these events, I see mostly domestic UK investors. Well, that was a long way. Let me see, I got some questions coming through, Richard. Should I pound some of these questions here?
Yeah, let me read them out. Just a quick note. Apologies earlier on to everyone. I know that we had some problems with sound, but hopefully that's now been resolved. But let me go to questions now. Don't be afraid to fire them in. So one for you, Walter. Given the current US situation, COVID-19, racial unrest and Trump, would you be more confident in investing in the US or the UK in the short and medium term?
Me, I would be definitely more confident in the UK, not so much because of the racial unrest and the COVID and Trump, but I think more in terms of, I worry about the regulatory structures in the US and particularly as the economy becomes more and more stressed. And well, I guess this is a bit of COVID. I got a feeling that the UK government will become a little bit less tax friendly over the course of, say, a 5-year investment. So I'd be a bit concerned about that. The other bit too is that the US had this uncanny knack for what's called territorial overreach. And I think one of the reasons that a lot of people that do not invest in the US do not invest in the US is because they don't want to have their businesses interrupted by their extraterritorial business interrupted by some connection they have in the US, as it were. They set up separate companies to do that, perhaps, but I think a lot of them stay away from it. And that's one of the big pluses of the UK is that it's always been regulatory friendly. That is, not necessarily bending over backwards to get people in, but at least it's got stability. You know, we don't have the lowest corporate tax rate in the world. We have a pretty fair one, I would say, and other sorts of things that get people in. I think that's the real pull factor of the UK rather than a push factor from the US, perhaps. Richard,
thank you. Okay. Let me go on to another one. Walter, are we likely to see negative interest rates in the UK?
Oh, now there's a question. I hope not. It just, the logic just doesn't add up for me. And that means that big institutional funds that hold our money can't even store it in a safe place, you know, without having to pay for it. But I saw some headlines the other day suggesting that they were entertaining this notion at the Monetary Policy Committee. I'd be very surprised if we see it. The only scenario that I could see is if something happening with sterling and that some emergency measures had to be taken, and they saw that as a way of trying to support the currency. But at the moment, I don't see the risk to the currency materializing just yet. So I'd say no on balance.
Okay, can I ask another one? Walter, how do you think the COVID-19 and government spending plans will affect the future high street funds and affect regeneration in the South West?
What do you mean by high street funds, I wonder? Let's see, what does that mean, Richard?
Retail funds, I guess.
Oh, the retail funds, the investment funds. Yeah, got you. How do you think COVID-19 and government spending plans will affect the future high street funds and affect regeneration in the Southwest? Okay, so COVID, I think, has probably accelerated the rate of structural change between the various conventional sectors, the retail sector and the industrial sector and so I think e-commerce probably has been given even more of a decisive boost with COVID because we've demonstrated exactly how far you can push it in order to support the population. And I do think it's probably got a lot more distance to run. Also, people that maybe didn't use the internet for specific reasons will now start to use it for those reasons just because they had no choice but over the last couple of months to go ahead and experience that. So I think there is that sort of structural shift that has been pushed forward. Consequently, I think that it's interesting when you think about regeneration. I do think that given it's all related to a redefinition of retail, a reuse of conventional retail pitches, morphing them into more mixed use, perhaps convenience retail offers, along with other sort of non-discretionary things such as doctor surgeries and all the rest of it. I could see that getting a little bit of a boost going forward. And those are definitely investable assets. I'd say one thing I can tell you about COVID over the last couple of months, investment transactions have definitely slowed, no question about that. But if you looked at the private rented sector, or you looked at the build to rent and some of the mixed use schemes are involved in, there's a lot of companies that have been spending the last couple of months land banking and spending a lot of money doing it, and also pushing plans forward for development of exactly these types of facilities. So I see that. I see regeneration as getting definitely a positive boost, not just in the Southwest, but right across the UK, and that plays right into the the government's regional rebalancing plans. And also don't forget, if you look around Bristol, there's a hell of a lot of projects that have really been pushed forward over the last several years, that are actually quite eye-watering in connection. I understand there's a lot of cranes on the Bristol horizon these days. Richard, I hadn't been to Bristol for a good 4 or 5 months, I don't think, so probably there's a bit more by then. I don't know if hopefully that answers the question.
Let's move on to another one. If regional recovery is dependent partly on consumer spending, will this not be constrained by anticipated increase in unemployment as a result of COVID, especially as the Southwest has material, leisure and hospitality sector?
No, I take the sentiment completely. I'm just hoping that I think I said early on that the longer that the lockdown goes on, the more difficult the recovery is going to be. And I think for obvious reasons. I think we're getting to the point now where the lockdown looks like it's going to be eased. Is it in time, or will it come in time so that all the furloughed employees manage to retain their jobs? Or does it get dragged out too long, or do we have a secondary peak which prevents an unlocking? That means that when the final furloughing plans come to an end and companies have to fully pay for their employees, we don't have a sudden unemployment spike. That's the big question. And look, I can't answer that one. I'm optimistic for the moment. Looking at some of the COVID numbers in terms of new cases in London, it's dropped to virtually nil in several of the like in Lambeth, where I live, there's been no cases for the last 3 or 4 days, according to the data. Pretty much around London, the number of cases are extremely limited now in terms of new cases, I should say, according to Health England data. Where the problem still exists is in regional entities, which were behind London. London got there first, primarily because we're the transport hub, aren't we? And so we're a little bit ahead by a good few weeks. So we'll have to see how that plays out. But what else is there to say about it? Yeah, so there's the leisure and hospitality sector. I think probably domestic tourism will probably be on the pickup for whatever exists of this summer, as well as going into postponed holidays, maybe that happen in the autumn. And I think a lot of that will be definitely more domestic focused rather than international focused. We'll see how that plays. So maybe that mitigates some of the hit that the hospitality sector and leisure sectors are feeling. But it's far from clear yet how exactly this is going to play out. Like I say, the quicker that we can safely come out of lockdown, the better.
I have a good one here. Do you foresee an increase in taxes to make up for the deficit that has been created by increased borrowing?
Not right away is the answer. So yeah, I've been thinking about this, and it makes me pretty uncomfortable to look at the level of debt, not just in the UK, which has actually stayed within reason, but when you look at the US, the trillions and trillions that they keep pumping into the system, and the Eurozone now is pumping huge amounts of money into it. Now we're doing the same thing. The good news is that so far the international capital markets are willing to support it to a large extent. Interest rates are set to remain phenomenally low over the course of the next 5 years. In 5 years' time, if you look at the forecast, they're suggesting that 10-year gilt in the UK is likely to be somewhere around 2.5%, which is about half of where it was back in, say, 2006, 2007, which means that we have time on our side as far as trying to pay that back. Don't forget, over time, too, inflation begins to erode exactly what those debts are. But I still get this, bad feeling, when you think intergenerationally, that we're just passing on what's getting to be a bigger, epic problem to some point that's beyond, say, the typical 5-year investment horizon for a lot of property investors. Will I be around to see, the piper having to be paid? Probably. How will our children deal with it? I really don't know. I'm just, for the moment, I think probably what has been done was the right thing to do. It wasn't a massive bailout of capitalists. It was a bailout of the people with their jobs, which I think was well overdue. Let's see now if all these investments that we're putting into the regions, which should theoretically result in higher productivity and new generation of industry, starts to generate higher levels of wealth, and maybe we won't have to go down the high taxes route. What I have seen so far in the immediate, what's to come, is that taxes will probably fall in the first instance on corporations, individuals. So we probably have a couple of year buffer before we start to feel it individually. It'll be through recouping from businesses, and who knows how far that's going to go, especially for, say, cross-border companies that are here. And also don't forget, we've got all these tax avoidance strategies that are used where you're booking profits in different jurisdictions. I think a lot of that's going to come under pressure too. So some of the stuff I think that Osborne began back around 2011.
We'll take just
I'll stop. I'm going on too long.
Yeah, we'll take just 2 more questions because time is running up towards the hour now.
Okay.
I'll give you the easier one to start with. What do you think is going to happen to universities?
Well, I've got a 18-year-old that didn't have to sit his A levels. It was sort of a mixed.
Sorry, we've lost Walter again. Let's see if he comes back.
It was like
Walter,
up to do it.
Can you hear me? Can you?
And he's not necessarily one of these overachiever types.
Walter,
okay, short answer.
Can you hear me, Walter?
18-year-old didn't ever live closer.
Okay, I'll tell you what, everyone.
I can hear you. Can you hear me?
We've got you in a very garbled way, Walter. So just try it one more time. Sorry.
Okay. Is that any better?
That's much better.
Very good. Okay. Oh yeah, the schools. I'd like to think that the universities would end up opening sometime in the autumn term. At the moment, all the words are that it's going to be done online. There are a lot of which might be driving some people in the audience that have a better answer for all this. I think there's a lot of students, my son's age 18, that are thinking about deferring because they don't want to go to university if it's doing online courses. Again, we don't know how this is going to play out until we get closer to the time. There'll be those that are doing programs that they just can't afford to delay, especially the long programs that take maybe 5 or 6 years. And I think they'll probably be in there in a big way. But I'd like to think that the universities are probably open probably sooner rather than later. But again, it's going to be linked to the lockdown and the medical conditions.
One last question, Walter. We've got you back clearly now. Last question then, and it's been asked a couple of times. What do you think the ultimate outcome of Brexit negotiations will be?
That's interesting. Yeah. This is an interesting one. I think the UK will get a lot of what it wants in the end, because I think the EU is in a fairly precarious position. They've already jettisoned their multi-year annual budget, as I understand it, to focus on the COVID response. There's talk about further and tighter integration at a level that would have been unspeakable a couple of years ago. I have a hard time accepting that it's going to happen, given the power blocks that exist within the EU. And so I think the EU could be in a certain degree of disarray at the crucial point. Of course, you could argue that the crucial point is about now. Boris Johnson has gone over, as I understand today, to negotiate the difficult bits as it were. And I'm not quite sure, I haven't heard what the results of that are going to be, but I do know within the whole context, there's an awful lot of flux in the system. And so, I just hope that they can come to some sort of generally amenable agreement. I fully foresee the possibility of there being some sort of limited disruption to cross-border physical goods trade, but I think services will probably be left untouched, partly because it's a pretty complicated thing to try to sort out in a short period of time, and the EU is as dependent on us as we are on them when it comes to that particular thing. So there could be some sort of interim transitory thing perhaps for certain sectors. We'll have to wait and see. It'll be interesting to have this back in the news rather than the COVID numbers. Listen, everybody, thank you very much for having the patience with the connection and everything. Sorry about that. And I hope that the message came through clear and that it was useful for you. And I'd be perfectly happy to take any sort of feedback. I think you can find my email pretty easily. And I look forward to seeing you out in Bristol the next time I'm out there. And hopefully it'll be sooner rather than later. Yeah, Richard?
Thank you, Walter. That's very kind. Thank you, everyone, for attending. And keep well, safe, and look forward to seeing you at work soon. Thank you very much.
Very good. Thank you.